What if I told you that you could make money in the market even during a crash?
What is quant investing?
Quant mutual fund.
What do you think of quants?
Quantitative investing is
Demystifying the world of quant investing.
In the past few years, this investment strategy has been quietly changing the game. However, most of the investors still don't fully understand this. Let's rewind a bit. After the COVID-19 pandemic, India saw a wave of retail investors flooding the market. But here's the catch. We are just scratching the surface compared to global standards. So imagine this. Lakhs of investors coming in, looking for smarter strategies to invest in. Enters quant investing. Quant investing means leaving emotions at the door, where stocks are picked by algorithms and AI using math and data and no gut feelings. The results? Some of these quant funds have delivered mind-blowing returns with an alpha of 12 to 15% over the 5-year period. But how exactly are these algorithms so good at making money? And more importantly, can they do it consistently? To fully understand this, we brought in someone who has actually used quant strategies in his funds and delivered very good returns even during a crash. Rishabh Nahar, the partner and fund manager at Qode Advisors.
I don't think you need to be a genius to be a successful investor. If you rank all the businesses in the market based on these two metrics, you would do like 25-30% per annum.
And with the AI entering into the world of investing, can quant investing really become your biggest edge? Well, there's only one way to find out. Hi everyone, welcome to another episode of Power Talks. Quant investing has been steadily rising in India. And to talk more about it, what it actually is, we have with us today Rishabh Nahar, the partner and fund manager at Qode Advisors. So Rishabh, welcome to Power Up. Thank you for taking out the time. And in a state where India, the active equity investing is, barely scratching the surface. Now with advanced techniques like quant investing, tell us more on what it actually is and what is the value add that it brings compared to the traditional investing.
I think most people think that quant investing is like a black box and it's going to pop up some sort of stock which will give you a multi-bagger. It's not as complicated as it sounds. I think the world is extremely complicated.
Got it.
But it's actually a very simple framework. It's actually here to make life a lot easier for most of us.
So simply speaking, right, if you could explain, like for example, in your quant data model, how does it work? What are the parameters that you put in and how do you decide those parameters?
Sure. So, maybe I'll get it down to like something really simple, right? So if you look at a legendary investor that everyone looks up to, say a Warren Buffett, I think he has a quant model in his mind. And the way his model works, for example, is that, say he has this rule that he never buys a tech stock.
Okay.
Right. And the reason is that he doesn't understand the business. Whatever the reason, is that's personal to him and his style of investing, right? There are two ways to go about this entire process. One is that you have very hard rules and you abide by those rules 100%. So what you would do is that you would put down these rules, you would get a list of businesses. You would rank each business and say by the top 20, 30 businesses.
Okay.
Now this ranking could be based on different factors like I mentioned, like promoter holding, return on capital employed. Or you could also go about this way, which is called quantamental, wherein you have these filters, but then you go deep dive and actually try to understand each business subjectively.
Okay.
So there are two ways of doing this. What we do at Qode is we do both of these in different strategies because we find merit in both of these approaches. But essentially, it's these set of rules that are put in place to pick businesses.
Okay. So then, is there a active fund manager or a person who is selecting after the quant model has filtered out a few stocks? There's still a need of a person?
So this is just one. So this is only for the ones where the businesses are really small.
Okay.
Right? And then we have another strategy wherein we are very strict with the quant rules and we don't meddle with the process at all. So once we've ranked businesses based on certain factors, that could be single or multi-factor, we actually go and pick all these businesses in different weightages.
Are there any also factors that incorporate human bias or like how do you predict like what US tariffs did to the market? How does that work? How do you sort of manage that in your model?
March, I think like most small cap indices or even the Nifty up until Feb were down about 25-30%, right? That's when our exposure to gold reduced and our exposure to like the mid and small cap. So those decisions are made by macroeconomic factors, but the business buying decision, there is, trade war and those things don't influence us because we understand the long-term it's not going to matter as much.
Right. There's a lot of short-term buying and selling, right? And it's very contrary to the whole traditional concept of buy and hold, because long-term may you will grow. So how does that work? Like, tell us more on how do you decide that short-term may you need to do all of these changes, taking aside the long-term view?
So, we like to think in terms of first principles.
Okay.
And if a stock has to do well, there needs to be earnings growth. That's a fundamental truth, right?
Of course, yeah.
So if there is earnings growth, the stock will do well. Now, I'm not worried. As a quant fund, at least, I can talk for, at Qode, we are not looking at anything on a short-term basis. We are not looking at a 3-6 month. We're not looking to churn the portfolio. Our objective is pretty much that we want to own good businesses. It's just that we're using quant as a tool to do something like that.
Right.
Yeah.
No, the reason I asked, I was just on my way, right? I was reading about one of your schemes, I think the all-weather, that in a month or like in a short time period was doing like 8-9%, while the benchmark was doing 3%. And hence the curiosity around, at a short-term basis, how did you manage to generate this big alpha?
Right. For us, risk management is key. As a quant fund, we get a lot of, because we have so much data, we can easily manage risk. So what we did with most of our strategies was that in the month of April, where we outperformed the index by a large margin, we had a put protection on.
Okay.
And we had exposure to gold. So we protect the portfolio using gold and put options.
Okay.
It's sort of like taking an insurance on the entire portfolio.
Okay.
And with gold, so at least in all weather, 40% of the portfolio always remains as gold.
Okay.
And gold did very well, equities did very badly, and there was a lot of divergence out there. So we did not take any tactical action in that month. We didn't trade. I don't think we even placed one trade in that month.
Okay.
So it was pretty much what the exposure, even the same positions that we held last month, we continue holding the same positions today. So that divergence came because of having exposure to gold and having a sort of an insurance on the portfolio. A lot of funds do now, in PMSs do buy put options to hedge the portfolio. So it's like buying a term insurance, right?
Got it. Tell me more on how the derivative, like the put option, is an insurance. Like for me as a retail investor in layman terms, how does that work?
So it's fairly simple, right? Like to clearly understand it, just think of it as a term insurance. Say you're like 25. For a 1 crore term insurance cover, you'd probably pay about 20,000 rupees, right? So if something happens to you, say the next year, your family or next of whoever's around would get a 1 crore payout, right? So the return is crazy, in monetary terms, right? So you pay 20,000 and you got a 1 crore payout out there. But say nothing happens to you for the next like 50 years, you'll yet keep paying that 20,000 rupees, and that is actually an expense out of your pocket.
Correct.
Right? It's not adding up to anything. You're not going to get any sum on maturity. That's exactly how a put option works.
Okay.
When you buy a put option, you're saying that if the market falls by like say 5% or 7%, I want a crazy payoff.
Okay.
Because I'm losing money on my stock portfolio, right? Because what we've seen generally in bear markets is correlation across the board goes to 1. If you look at 2008, 2020, whether it's an HDFC Bank, an HUL, or even a microcap stock, everything fell. Right? So there is no hiding in the form of diversification. So we find that like buying these put options, so it's a very small cost to the portfolio.
Okay.
But you have to do it tactically. It's not as simple as, just buy it and keep it. We run a quant model on that as to when do we want to buy it, when do we want to sell it. But that is purely price driven, and it composes a very small part of the portfolio. So it's less than 1% of the entire portfolio is invested in something like that.
Got it. Do you think, are there certain weaknesses or basically some places where quant models would not work compared to a traditional investing model?
The thing is that data is very scattered today, right? But when you look at the smaller businesses where mutual funds have not entered, where PMSs like us could, dwell into, I think the edge lies out there. Now, in those businesses, some of those businesses do provide very clean data. So where we can actually, quant models can process all that. But then there are fairly small businesses which are like family run, wherein there is no data. You have to meet the management. And that's where an active investing approach really works. I think the biggest thing with the stock market is it's a matter of discipline and following a certain set of rules and doing that repeatedly day after day, year after day. You're not looking for a jackpot in a year. That's not the objective, right? Like when we promote SIPs. What we're trying to say is that you just keep, doing this consistently, right?
Yeah.
The beauty about an SIP is not that you're picking the right mutual fund. The beauty is that you're going to do
Staying
this.
there.
Yeah, you're staying invested regardless of the situation.
Right.
That's exactly what we're trying to achieve with the quant model, but from a stock picking perspective. That I don't want subjectivity. I don't want those biases, whether promoter looks good, whether the promoter is, can I just have data over the promoter? Can I have the age of the promoter?
Right.
For example, I don't want to own a stock where the promoter is 75 because he has probably a very short runway. But I want to own, I'm more interested in owning a business where the promoter is in his 30s and 40s because I know he has a long runway. So if I can quantify these things, it makes my life so much easier, right?
Right.
So,
makes sense.
Yeah.
Yeah. And one more doubt I have, right? I have all these doubts because, just being curious mind. So you would probably backtest all of this data, right? With the historic numbers. Traditionally, for example, and I'll give this instance, right? Usually it's seen when inflation rises, growth slows down. But abhi kya ho raha hai? Growth is also rising, inflation is also rising.
Correct.
Now then, when you backtest this model, maybe it will fall apart. Like, how do you take care of such situations?
When you say that, say I'm backtesting for the last 20 years. What's important when you're looking at a backtest is that the environment that's going to come in the future should be similar to the environment that's happened in the past.
Correct.
Right?
Yeah.
Now, if you, it's a slightly complicated concept, but we are in the era of fiat currency. When we say fiat currency, that means that there's unlimited amount of money printing that's allowed to happen. So if you go back like 60, 70 years, what used to happen was every rupee that was printed by the RBI, 1 rupee worth of gold was put in a locker, which then changed. So if you open up a 10 rupee note or a 20 rupee note, 100 rupee note, it says that I, the bearer,
I
owe the bearer, right? So where the government is saying that, what, if someone comes to me with this note, what will I get? You'll get gold in return. You should get gold in return. But that stopped in 1970 when in US there was a president Nixon who came in and said that this is we don't need to back this by gold. We can print any amount of money. So we are in this era where the value of money will keep getting it'll keep diminishing. So it'll get devalued. If you look at any asset, whether it's real estate, whether it's equity, whether it's gold, it's always been rising since the last 30-40 years.
Right.
And I think this is going to continue as long as we are in this era of fiat currency. So this is more of a macro analysis of how the world works. It starts with the barter system, and then the last stage is where we are today in the fiat currency, and then it gets reset. It's like a 80-90 year cycle. To elaborate a little bit on this, for example, when COVID happened, it would be a surprise for most people, but it wasn't a surprise for a lot of us on the quant side because something like this happened in like 1918 when there was a Spanish flu. The disease was different, but the consequences were the same. Government shut down, countries shut down, economies went into shambles. What happens then? The government starts printing money. So when you look at data, what I believe is that everything that's going to happen in the future has happened in the past in some way or the other. It might not be a direct way because see, the world has existed for thousands of years. Countries have existed, governments have existed. So a lot of these events have happened. All you have to do is that study. And human behavior pretty much remains the same. Yeah. Between fear and greed.
Right.
So you have to be according to me today, if you ask me like what's there for the next 10 years for people to know, I think it's very important that you be an owner of assets, equity, gold, real estate, whatever it is. Because in this era of money printing, money in the bank will get devalued. You will not realize how you will become poor without actually losing any money. Right. So, for example, a McDonald's burger would cost 20 rupees. Back in 2015, probably cost like 60 rupees now.
And coming to the big question, right? Me as a retail investor, now, of course, I don't have access to the PMS that uses quant techniques. But, I want to do, active investing and want to generate returns so that I can take care of my lifestyle inflation as well. Is there a framework that I can follow in my life, which helps me pick the right assets? What would be that?
So when I started my journey, I actually read this book. It was called The Little Book That Beats the Market. And it's like a 50-page book, a really small book. It's actually a little book. And what that guy gave was that he just said that like there are these two elements, which is EV by EBITDA and ROCE. The two financial metrics. So return on capital employed. So one is shows the strength of a balance sheet or the company, and the second is the valuation of the company.
Right.
If you rank all the businesses in the market based on these two metrics, right? So the higher the ROC, the better the lower the valuation, the better.
Right.
So if you rank, give 50% weightage to these things. And if you rank all the businesses, say 500 businesses, and you just bought the top 13 in equal weightage, you would do like 25-30% per annum. So when we started back in 2016-17, is said, fine, why not test this ourselves? So, we just sat down, gathered all the data. Data is not that hard to find. There are like a lot of data sources, paid, unpaid. But, once you get all the data, what we did was we took data from like 99 or 2000 up until 2017. Now we've updated our models. We've been running the same model live. We've obviously added our elements to it. But, if you just did something like this, or if you did only a return on capital employed, you just rank businesses based on return on capital employed by the top 30. Then the next year you again rank it. You just do this once a year.
Okay.
The next year you again rank it. Maybe 10-15 will go out, 10-15 new businesses will come in.
Correct.
Why we do it only once a year? Because we're looking to go for a long-term capital. And if you do this repeatedly for the last 20 years, you would have done north of 25% per annum.
Oh, wow.
So almost 26% per annum. I don't have an idea whether the promoter is a good guy or a bad guy. But every year I have just followed this model for myself and for other people. And it's been that powerful.
Wow.
Right? So anyone can absolutely do this. You don't need to know anything about the business. And you could add your own metrics, right? Like, see, the thing is that investing is a very personal game. I like to own certain kind of businesses, I like to own certain kind of, I don't like to, for example, I don't like turnaround kind of situations. I don't like businesses that have high debt. So I put in those filters and say, okay, fine, what if I just tested this out?
Right.
Because I'm comfortable owning these businesses with these kind of metrics.
Right.
And we've had winners like Tata Elxsi was like one of our largest winners. It became a 8 or 9x for us without us knowing, what is the core business.
Right. Just basis the metric.
Yeah. So the simplest quant model that exists out there is a Nifty. So Nifty is actually a quant model.
Okay.
If you look at the 50 stocks in the Nifty, how are they selected? They are.
But isn't it like the top 50 market cap?
Yeah. So that's a formula, right?
Okay.
So someone has written a formula that, okay, whichever top 50 based on free float market cap will get included. And I think that changes once in 6 months.
Yeah.
So something like a Nifty, which is so silly, no fundamental factors, has done 12%. So if you throw in some fundamental factors and you want to own fundamentally good businesses,
right,
you could do a lot better.
Very interesting.
Yeah.
I think the key thing for me also to take away is just stick with the rules. Don't include your human bias and human emotions. I think it all falls flat जब अपना portfolio ready में दिखने लग जाता है.
I think like that also quant really helps you out, because what happens is when you pick a bad stock, you start blaming yourself, right? So the thing with the stock market is always full of regrets. That's a given. You bought a stock at 100, it went to 150, you'll think I didn't buy enough.
Right.
Say you sold at 150 and it went to 170, you'll think I sold too early.
Yeah.
The thing with a quant model is that if you're not actively picking, you don't blame yourself. You'll say, oh, the model is doing this.
Right.
So it sort of sidelines it helps you emotionally in this entire process.
And on that note, Rishabh, like you said, you've been active investors for a long time. What is your personal portfolio like? How do you invest? Tell us more on your portfolio allocation if you can.
So I like to follow the quant model completely to 100%. There are some businesses that I do. If I don't follow quant model, then there are businesses where I would want to have asymmetrical returns.
Okay.
Wherein the price that I'm entering at and the runway that I'm looking at, there should be a potential to become a 100-bagger.
Okay.
Right. And then I'm actually going deep dive and understanding the business. As long I'm only looking at those businesses where there's no data available. So that's about 20% of my portfolio. 80% of my portfolio is pretty much driven by a quant model.
Okay.
Where I know that like I will do better than at least. See, I don't want to hit the ball out of the park in 1 year. I'm not looking at that. Right. The moment you increase your time horizon to 10, 15, 20 years, you anyways eliminated most of the competition.
Right.
Because no one is thinking 15 years out.
Correct.
Right. No one is thinking 20 years out.
Yeah. Or rather, I think we think 20 years, but practically we can't. I mean, 2 years, 3 years later, you feel like, oh, zyada ho gaya, chalo, let me take it out. Red ho gaya, let me take it out.
So all you have to keep training your mind and reminding yourself that, this is a long-term game. There are certain principles that you got to live by. And I think if you just follow those simple rules, anyone can be extremely successful.
Now, with the advent of AI, do you think quant models, like, can they be replaced and disrupted completely by AI? And for me also as a retail person, right, can I just train a model and park it, and leverage AI to generate certain amounts of returns?
So the way we look at AI is, or the way I look at AI is that AI we use as a tool. The way I look at quant, I also use it as a tool. you have to use your own intelligence because of the kind of businesses you want to own. So what AI is doing is making the entire research process a lot faster. So the code or the data processing that would take, say, a month to do, back in the day would probably take 1 day today. All thanks to faster writing of code.
Yeah.
And the AI models are helping you actually do the research. Say if I want data from a presentation, right? Earlier, like back in 2015, I would read the entire presentation. I would go through the transcript of a company con call, which I don't need to. I can just upload it, in any AI model. Say like I use Perplexity, and I could just upload it out there, and it could give me a summary that these are the most important things without actually missing out on anything. So what would take me 5 days is happening in 1 day. And I think we've seen this entire shift of information flowing a lot faster. I don't think it will replace the stock picking journey, or it's going to help you predict in any way. If you want to go down the journey of quant investing, I think AI can make it a lot faster. You don't need to know, like in 2012, 13, 14, you would need to know how to code. You would have to backtest. These things can be easily done by AI. It is not the primary factor for success. I think the primary factor is yet that you have to stay disciplined. You want to just own the right businesses. But using AI, you can make quant investing a lot easier. Your research becomes so much faster. You don't need to spend hours a day. And once you've made a model, I don't think it needs to be fast moving. So someone can, spend probably, one day in a week or 1 day in a month to just, make sure that what you own remains. It doesn't need to keep changing.
Right. Coming back to Rishabh, the weaknesses that we were talking about, right, on the quant models, and we spoke about the backtesting thing. Another thing, and a question in my mind was that because it's based on a lot of data, and tomorrow if SEBI cracks down on the data restrictions and we don't have access to data, how will the quant models work then? Like, is there a planning for that?
So I think there are two kinds of data. One is the fundamental data that companies provide, and one is price data that which we get through broker using their APIs, or you can take it from the exchange directly.
Correct.
For most of our models, price does not play any big factor. What's important is the fundamental factors, right? And that's public information, and that has to be public information because if you're a listed company, your mandate is that you share data, like you share your quarterly result. Right. Because the moment you become a shareholder, you become an owner. So they have to email you their annual report. They have to send out their quarterly statements. So that is something that, that is going to be public information forever if it's going to be a listed entity. Right. So I don't think so. Even if the price data stops, what you're talking about, it is not going to change my view of the market in any way, or it's not going to really affect my model. It might affect in short term, but over a long term, it does not make any changes.
Right. Because it's ultimately based on the fundamental metrics.
Right? Yeah.
Got it. Yeah. And, aligning to that, right? So, for example, if the market takes some sharp downturns, right? So, for an actively managed fund, right, there's a person who is looking at it and, sort of making course corrections. But for quant models, they are running basis, whatever is happening. What happens in those cases, right? How do you do you change your models at that moment? What do you do?
So we try to refrain from changing our models on a very short-term basis. We on a day-to-day basis, we are constantly working on our models because data is updating every day. We're also looking at newer markets, looking at more data. We obviously know that we are not the best at this. There's always a lot to learn. So there is that challenge that, if say, for example, something comes up really suddenly and it has to, it is subjectively affecting the model, then we don't take a subjective bet, but we try to see instances like that. So from 2020 to 25, you speak to anyone, we see the price of products gone up, the price of real estate, equities, everything has gone fivefold.
Yeah.
And the reason for that is because of money printing. So if I was back in 2020, I was pretty sure that I want to be an owner of an asset.
Right. Makes sense.
Yeah.
Makes sense.
Yeah.
And Rishabh, going forward, right, the way ahead for quant or for markets in general, what's your view on the next 3, 4, 5 years of Indian market?
So the Indian market is obviously driven by macro factors also, because we produce, the West consumes, right? That's how it and their markets do affect us. Where US is placed today is a very tricky situation. They're sitting on $28 to $30 trillion of debt, which is going to mature in the next 4 years. If it matures, so now, when this tariff war happened, which everyone knows about, we saw that Trump was really bullying everyone, right? Like, one day he would say tariff on you, one day he would say tariff on you.
Yeah.
So people don't trust him as much now. If people don't trust him as much now, they're not going to buy his debt anymore. I don't want a US government bond anymore, because what if this guy says after 10 years, I don't owe you anything. So when this 28 trillion is going to mature, he'll have to refinance it. People have to, say China's one of the largest holders of their debt. They are going to say, we don't want to buy any more debt, just give our money back and we are done. Aapko loan diya tha humne, and we loan chuka ke khatam karo. So, but they have to refinance it.
Right.
So they'll have to go and print money. So the central government will go to the central bank saying, okay, let's print money. In 2020, they printed $5 trillion or $4 trillion. And we saw inflation went to 9%. And you saw for yourself that how mutual funds and equity and real estate has performed in the last 5 years.
Right.
The expectation is they probably have to print $10-15 trillion over the next 4-5 years.
To refinance the entire
Exactly.
thing.
If that happens, I mean, you have to own assets. You can't, so the view is that you can't, whether it's real estate, whether it's equities, you will not realize the value of money, will diminish tremendously. So if you're an owner of assets, you're pretty safe. You don't have to worry about anything.
Right.
The moment you own equities, the moment you own...
Right. And, the passives are rising even in India, and West has already sort of peaked, and most of the investments are in passive funds. Now, quant models are mostly based on finding these inefficiencies, because active stock picking may, you miss that out.
Yeah.
As the passive increase, will they continue to generate alpha like in future?
So it depends on what kind of passive fund you're looking at. If those passive funds, like there are a lot of these Nifty strategy funds right now that are there, which actually look at fundamental factors. I would, definitely, like as an investor, I would definitely look at these funds because they're low cost. So that line between quant and passive is very thin. Ultimately, you want to be the owner of that business. So even if it's a passive fund, but if it's looking at fundamental factors, I would definitely be interested.
Interesting. Nice.
Yeah.
Nice. I think lots of learning, Rishabh, today, not just on what it is, but, how the macroeconomic factors, how US will impact. And I think lots of learnings here. I think final note and my final question here to you would be, as a retail investor, right? Give me a framework that I can apply, a quant-based framework for active investing in my, finance journey that I can apply and, generate good returns. What would that be?
So whenever we are making a model, what we say is that think in terms of first principles. Keep it as simple as possible, and it should be something that you understand. Because like you mentioned earlier, right? Like the problem is when the markets fall and then you fall flat on your face because you're like, then you'll say that this model does not work, right? So if you create a framework around things that you understand and are fairly simple, are low in terms of churn, low in terms of cost. Right? You're not paying taxes to the government for no reason. Right? You want to let compounding play out. I think then if you do anything, it could be really, you could be successful. You could beat most of the fund managers in the country. Right? You don't need to be I don't think you need to be a genius to be a successful investor. Right.
I think that's my biggest takeaway from today's conversation. I think perfect note to end this conversation, Rishabh. Thank you so much for taking out the time. I learned so much today, and hopefully I'll apply some of these principles and train my mind to stay disciplined. Thank you so much.
Thanks, Navda. Thanks a lot for having me.